what do you think there was an earlier question. What do you think about it in the number of uncorrelated bets that you can create in a portfolio? Or is it sort of, you've got structural sort of the viewpoint, so there's 4, or there's 5, or there's 3? Like, obviously, if we could all get 20 uncorrelated bet streams, would be great. What do you think there actually are? Are there new ones coming? Is Bitcoin one? When would you think an asset class might cross the chasm to, frontier, to being included? Any thoughts? That was a lot of questions. I'm sorry. Just answer the first 5.
The last big one was tips, and I was, these things move slow, and that was 20 plus years ago. I saw a question earlier, which is how many uncorrelated bets are there?
Right.
Asset classes, you're limited. They're not really even uncorrelated. They might be uncorrelated over time, but they may be correlated for a decade at a time.
Mm-hmm.
Right. So finding these uncorrelated assets is a lot harder to do than might seem. So I would think of it as, if environment A transpires, what's likely to do well. And so when we go through that process, we get to 4 or 5. If you think of gold as a separate asset class versus commodities, maybe real estate could fit in there. And then you're starting to move into alternative asset classes that are not as liquid, not as well understood, hasn't been around long enough, but we're always looking.
Right.
But you need a positive risk premium, right? You want some liquidity, you want some history, and you want a clear economic bias. And that just takes a long time to collect all that data.
For sure. Well, it takes a long time for the structural sort of implications of an asset class. Like, you think about tips, right? So you have to, government has to manufacture them. They have to start trading. There's all the infrastructure that's involved with trading. And so there's a lot to that from that perspective. So.
Yeah, but if you can jump in early, you can actually benefit. So tips, for example, since their inception, their Sharpe ratio blows everything else away. I mean, they've actually outperformed stocks since they came out by a few percentages a year.
I think that is why. What's unique about tips that has made them work as well as they have?
I think part of it is they're widely misunderstood. It's really interesting when you see how they behave. Oftentimes, it's not what you expect initially, and then they behave exactly as you expect. There's less liquidity there than in treasuries, and that liquidity has been increasing, and I would suspect there'd be more issuance there. Obviously limited history, so investors take a long time before they buy. So maybe the first 10 years they did exceptionally well. Obviously, you had falling real yields during its inception, so that's helped. But what's remarkable is you've had such great returns in tips without inflation, right? Inflation actually has been falling, which gives you a sense of how well it could actually do, especially if we live in a world of negative real yields for an extended period.
Well, in your book, you mentioned you dissect tips into them being a hybrid between inflation protection and growth shocks, right? So it's kind of like a little bit of a 10-year treasury and a little bit of a gold, but it's actually more directly correlated. Well, it's directly correlated to the CPI.
Yeah.
And so its ideal place is when there is a negative growth shock and positive inflation shock, right? That's when they kind of will do better than either of them.
Yeah, which is the exact opposite of equities. So if you told me, hey, you only have 2 assets to build a diversified portfolio, you could just buy equities and tips.
Yeah.
Because their bias is the exact opposite. And like a perfect example is the 1970s, right? That we didn't have tips at the time, but that probably would have rivaled gold. Gold earned 30% a year for 10 years, right?
I
would have been up there.
I actually think that's the reason why risk parity gets such a bad name. I think that people may have heard somebody say, look, a good risk parity portfolio is some tips and some equities. And then they just hear bonds and equities. And then they say, well, in the 70s, they correlated to each other.
Right.
It's amazing how pervasive that view that's just those 2 asset classes is.
Yeah.
In your rounds of talking about risk parity, how often do you have to deal with that objection and disabuse people of that?
Quite often. The other part of that is pretty interesting is there's I think, an over focus on correlation. So people will say, oh, the correlation of, X and Y were high recently, and you're assuming that they're going to be low. And so that you have a failed assumption there. And it's not about correlation, because, you can take any two asset classes and they could all go through periods of high correlation or even negative correlation. It's about the economic bias. So you just look at stocks and bonds, right? In the 80s and 90s, they were highly correlated, right? Because you had falling inflation, and they're both biased to do well in that environment. And in the 70s, they were highly correlated because you had rising inflation. But in periods where it's growth that's really moving, like the 2000s, that was the real driver. Inflation didn't really move very much, but growth was all over the place. The correlation was negative, right? So correlation is just the manifestation of the environment, right? And so I think there's an over focus on
a good point
on the specific numbers. You have to think about the economic bias, and most people don't think in that framework.
It's kind of the relationships that manifest over much longer time periods than this sort of, oh, there was correlation for 10 years. No. And you don't even have to know the correlation in the short, like just know that they're sort of generally not correlated in the longer term. And that all the error terms that are happening in the short term, they're going to kind of offset and they're going to do some funky stuff.
Yeah.
But that's one of the things, you're right. People will be very precise about, oh, well, they're correlated or not over a decade or 5 years. And I just like hand to forehead. I'm like,
right. With all this computer power, there's a sense of obligation of trying to fine tune the machine.
Right.
And
be precise.
you can't fine tune it. Like, the market is so peculiar, because when you try to fine tune it, it'll literally work against you, because that's how it prices, right? It discounts what the inputs are, right? Discounts what the consensus view is. And so you're much better off zooming out and forgetting the details and forgetting the noise and just looking at the fundamental relationships that are true, even without studying the data. You just know that, if the economy weakens, rates will fall. And it's because of what the Fed's going to do. There's these natural relationships that are far more reliable than trying to guess what the Sharpe ratio is, or what the expected return is, or the expected risk, or the correlation, all the inputs into an optimizer, right? You're trying to create precision out of something that's not precise.